The U.S. Treasury is once again criticizing China for its lack of flexibility with the yuan, but they did fall short of labeling that nation a currency manipulator. In a report released yesterday, the Treasury said that the Chinese currency is, quote unquote, undervalued. So I asked one of the foremost China experts, Stephen Roach, the chairman of Morgan Stanley Asia, whether that's accurate.
China pegs its currency to the dollar more loosely than they used to, but this is their choice. They have an embryonic financial system, and they need an anchor. And to them, the anchor is the world's still reserve currency, the U.S. dollar, and that's the way they run the system.
But criticizing the lack of flexibility, but not calling them a currency manipulator, is sort of hedging in some ways on the part of Treasury. You point out in your book that any kind of dollar crisis during the recovery from this financial crisis would really be a lose-lose scenario for the U.S. and for China. Is phrasing like that from the Treasury politically minded?
They're trying to cut it both ways. It's a politically contentious issue, and my guess, Margaret, it's going to get more contentious as we move into 2010 and the midterm elections, with the unemployment rate likely to be 9% or higher during most of 2010. And there are going to be a lot of cries on both sides of the aisle to do something about the plight of the American worker. And China is, unfortunately, the whipping boy in many of these discussions.
This week, there was more than a $3 billion pact in regard to energy and other sort of political alliances that are coming about as a result of energy alliances between Beijing and Moscow. There's some concern about them becoming allies and what that could mean for the United States.
Look, I think we're a long ways away from a new alliance between China and Russia. But what the United States has to think long and hard about is the idea that as China progresses down the road of economic development and becomes less reliant on exports, more reliant on its internal demand, it will move outside the sphere of influence of the United States. Right now, there's a sort of a great mutual attraction between these two nations. We buy their exports, and they buy our treasuries. But the day will come when they're less reliant on us. We still may need a lender, an international lender of last resort. And who's going to help us out? It's a fair question.
When you look at the question of the Chinese consumer and whether they're going to start spending and save a little bit less right now, tremendous government stimulus to encourage some spending as well in China, luxury brands seem to be very excited about the potential of the Chinese consumer there. Are they expecting a bit too much too early?
Well, it's a huge population, as you know, and as you travel around coastal China, as I do on a regular basis, you see these enormous outlets for all the major luxury brands. But the consumer story in China is a story that has to go well beyond these niche players. And right now, there's still a huge bias toward high levels of saving in China. And that's an outgrowth of the fact that the government has really not built much of a social safety net. So until they can address that key issue, I think the development of a broad-based consumer culture is still too far out in time.
Well, given that with some of the coastal manufacturing centers, I think you cite job losses of over 15% in some areas, how does that trickle through to political stability?
Well, you're on to the most important constraint in China, and those are two words: social stability. Anything the Chinese do to jeopardize that is always perceived to be a big internal political risk. So last year, when the export business collapsed and reports of over 20 million migrant workers having lost their job in export-led Guangdong province, that was a real alarm in Beijing, and was the major development, in my view, that spurred them to a massive fiscal stimulus that was enacted in November.
And there may be a fair amount of competition between the two. Certainly of late, the question of China and the amount that they are spending to garner resources. I think it was $13 billion on assets that they've spent since December overseas, just to have the kind of commodities they need to fuel the economic growth they want. How much competition are we going to see in the immediate term between a China, an India, a South Korea on that front?
This gets to the heart of one of the most important inefficiencies of the Chinese model. They consume over twice as much oil per unit of GDP than the rest of the world is. They also are very inefficient consumers of base metals and other industrial materials. The government has talked for years about this new scientific model of development. It's time to put that science to work and come up with a lighter, cleaner, a more environmentally friendly GDP. They seem to be focused on that, but thus far the real signs of progress are lacking on those fronts.
That was Stephen Roach, chairman of Morgan Stanley Asia and author of the book, The Next Asia.